There is an outsized risk with Snowflake, AirBnB, DoorDash and Roblox's IPOs showing an extreme increase in valuation since the last private funding round that will be hard for the public markets to absorb. I dug up some comparative research between 2019 IPOs and 2020 IPOs and described this outsized risk, which is tenfold from the IPO class of 2019. More times than not, IPOs lead to losses for retail investors, and there are specific reasons as to why. These reasons have only gotten worse with loosened IPO regulations. We also look at why raising capital at the same time as a direct listing shifts too much risk to the general public. Despite the hype that flashy IPOs draw, more than 60% of the 7,000 IPOs from 1975 to 2011 had negative absolute returns 5 years later. However, the 40% odds for success through 2011 are better odds than what investors face today. Before we talk about the serious red flags in the IPO scene of 2020, I want to visit what 2019 looked like as a reference point. In 2019, Zoom Video and Crowdstrike went public with the fastest growth levels the tech industry has ever seen. We will use these two as a baseline because their top-line financials at time of IPO continue to exceed any tech IPO we have seen since. Source: Snowflake IPO. In-depth analysis. In the case of Crowdstrike, the company's last private valuation prior to going public was in May of 2018 for $3 billion. The initial price that institutions paid was $7 billion and the shares began trading at a $11 billion valuation. When we average out the premium paid between the last private valuation and the opening price of $8 billion on a per-month basis for the time it took to go public, retailers paid a premium of $615 million per month across 13 months. Crowdstrike went on to have a volatile trading history in the first year with a peak-to-trough drop of roughly 50% within 6 months. Zoom Video's last private valuation prior to going public was $1 billion in April of 2017. The initial price institutions paid was $9.2 billion in April of 2019, with shares opening at a $20 billion valuation. When the $19 billion is averaged out across the 27 months between Zoom's last private round, the premium retailers paid on valuation is $703 million per month. This is about $90 million more per month than Crowdstrike. Notably, I covered Zoom Video as the best Silicon Valley IPO at the time of its listing, but the IO fund waited until the following January 2020 to enter the stock at $62. Despite perfect earnings beats, it took Zoom Video an entire year before it consistently traded above its opening price. The point of this is to illustrate that tech's top growth companies had their valuations increase an average of $600 to $700 million per month range since the last private valuation. These opening prices, which ranged from an increase in valuation of $5 to $10 billion, required a year to absorb.